Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. We have an excellent show for you today, and as always, send your questions to Brian Rezny at ReznyWealth.com. You know, it's vitally important that you structure your portfolio for 2025 and really the next 3 to 5 years. We have a new administration coming in. We've got some dynamics that are going to happen with, in our opinion, the U.S. economy on a very growth trajectory. And I think ultimately, if your portfolio is properly positioned as you enter 2025 in the next 3 to 5 years, you're going to be a very happy investor. As a money management firm, remember, Rezny Wealth Management is a money management firm. We actually manage our clients' money, and we'll talk more about that in a minute. We've already positioned our client portfolios for what we feel to be a very good growth spurt in the U.S. economy for 25 and beyond. There's areas that I will discuss further in the show, not only in the technology sector, primarily that we have our heaviest weighting, but I ultimately feel the U.S. economy is going to be one of the most vibrant places to be invested the next 3 to 5 years. And if you have money internationally, you're making a mistake. If you have money in emerging markets, you're making a mistake. If you have too much money sitting in conservative bonds, you're probably making a huge mistake. So we'll talk more about that throughout the show. But ultimately, what I want to talk about today is the key differences between a fee-only fiduciary money manager and, let's say, an advisor who's working at a Wall Street firm, bank, insurance company, or an independent broker-dealer. We get a lot of questions on this, and rightfully so. People are confused. They ask me all the time, isn't my person a fee-only fiduciary money manager at that big Wall Street firm? And our comment usually is, absolutely not. There are no banks, insurance companies, or broker-dealers that are fee-only as number one. But let's talk about a fee-only fiduciary money manager like Rezny Wealth Management. First off, our compensation, we receive payments exclusively from you, the client, as a percent of assets we manage. As a fiduciary, our duty is always legally obligated to act in your client's best interest all of the time. Not part of the time, but all the time. Our focus as a money manager is to manage your money correctly and timely and make those important changes and do the daily research and heavy lifting that most individuals don't have the time or want to do. The big difference is now between, let's say, an advisor that you're probably currently working with who is fee-based at, again, a Wall Street-style firm, bank, insurance company, or an independent broker-dealer. An advisor with these firms is compensated on a combination of fees and commissions that are coming out of your account. They're not fee only. The fiduciary duty with an advisor, they are only held to the suitability standard rather than the fiduciary standard a lot of the time. Let me discuss. When you're not a fiduciary 100% of the time, it means you don't act in the client's interest 100% of the time. So a lot of these advisors, or I would say the majority of these advisors at these other firms, work fee-based. That means sometimes they're fiduciary and sometimes they're not. Sometimes they work in your best interest and a lot of times they don't. The focus of an advisor is misunderstood by you, the investor. They often prioritize sales of financial products and services that him or her firm requires them to sell. Most advisors don't actually manage any money at all. They actually sell services of other firms. Third-party money managers would be a great example of that. Let's talk about the key distinctions between a money manager like Rezny Wealth Management versus an advisor at your Wall Street bank or insurance company. A fee-only fiduciary money manager actively manages your money, while fee-based and commission advisors focus on selling financial products that others manage for you. In summary, a fee-only fiduciary money manager offers a more transparent, conflict-free approach to wealth management, focusing on the client's best interest and actually manages your money. In contrast, an advisor working for a fee-based or commission structure prioritizes product sales or investment sales over comprehensive financial management, inducing conflicts of interest that will impact your overall well-being and will impact the recommendations they ultimately give you, which is detrimental to your wealth. Let's go to Tim in Cape Coral. My advisor keeps international investments in my portfolio. I know you're against international investments now. He says you need to be diversified. How long do you hold losers? It's like 5 years and nothing. We also own some non-traded REITs, which also have done poorly. What's your advice? Great question. So bottom line is this. If you look at where the growth of the world is coming and where it really has been the last 5 or 10 years, it was in the U.S. If you've owned international investments the last 5, 10, 15, 20 years, they have been a lousy performer. And in our opinion, international investing needs to be out of your portfolio immediately. You need to be invested U.S.-centric and diversified within the U.S. You can diversify within the U.S. without adding international exposure. With the new president coming in, with the new agenda to grow the U.S. economy and America First agenda, that is only going to further hurt international companies and emerging market economies. That means the U.S. economy will do better. U.S.-centric companies will have a better opportunity for more profits. So how do you want to invest your money? Get rid of international. Stop listening to that so-called advisor, because that person is probably not managing any money at all, and they're doing stock asset allocation, and it's a set it and forget it approach. Stay in the U.S., get rid of international and emerging market exposure, be properly diversified here, and I firmly believe 2025 could be one of your best years yet. John in Florida. If I move $500K from my IRA into my Roth and pay for the tax from my current Roth account, does that make sense? No, it does not. So what you want to do, John, if you're going to do what's called an IRA to Roth conversion, you want to pay the tax with after-tax money. So if you move $50,000 from an IRA to a Roth, and let's say you owe, as a number, $5,000 of income tax, you would want to take that $5,000 from a taxable account. You had a joint account with your wife as an example. Take the money from there, utilize that money to pay the taxes. The key to having money tax deferred in an IRA is keeping it all invested and tax deferred. The key to moving money over into a Roth as a conversion is keeping all that money in the Roth that then grows tax free. You do not want to pay the tax if you don't have to with money from either an IRA or Roth. Use a taxable account. That's your best strategy. David in Naples, Florida. My advisor, who is fee-based, wants my wife and I to convert our IRAs into an annuity for lifetime income. I know you're against annuities, but does that sound like a good strategy? David, that sounds like an awful strategy. Let me explain. Your advisor, first off, is your typical advisor. Probably fee-based, probably commission, certainly a combination of the two. Your advisor is looking to basically get an extra paycheck by taking your IRAs, putting it into an insanely expensive annuity, insanely locking your money up with big surrender penalties for 8, 10, 15 years long. And what you're going to realize is by doing that, it's going to hurt your return because of the cost structure of the annuities and how poorly annuities are, or annuities are in general, as investment in your portfolio. So what you should do immediately, go to ReznyWealth.com, click on our special reports tab. Download for free Why Annuities Are Dangerous to Your Wealth and Retirement. Read that annuity report. It will open your eyes. You'll now realize your advisor is acting no more than a salesperson trying to railroad your retirement into a high commission annuity that's going to be at the detriment of you and your wife's retirement security. Do not do it. The next step would be call my office during the week, schedule a consultation, and move your accounts to a real money management firm like Rezny Wealth Management and get rid of the massive conflicts and the bad advice that your current fee-based advisor is putting and pushing on your overall financial security. I'm going to take a quick break. As always, send your questions to Brian Rezny at ReznyWealth.com, and make sure you visit our website, ReznyWealth.com. Download any of our groundbreaking reports. You can also sign up for a consultation. We do manage larger portfolios, and of course, consultation requests are for those of you who would like to discuss our services because you're not happy with the way your money's currently being managed. I've just released a groundbreaking report, the 3 biggest risks you must avoid now. If you're a retiree, pre-retiree, have at least $500,000, this is a must-read report. I've covered the risks to your financial security and the facts you need to know to protect your hard-earned retirement savings. If you're at all questioning the advice you're receiving or your portfolio is lacking returns, go to ReznyWealth.com and download your free copy. I hope you're enjoying today's program, and as always, send your questions to Brian Rezny at ReznyWealth.com. One of the things I want to talk about today is avoid these three investments in your for your retirement security, basically. I often get asked, what are the top 3 investments, top 5, top 10 investments that investors should avoid? I want to talk about 3. These are the 3 most sold investments, either by a fee-based advisor or by a commission advisor, or the combination of the two. And why are these investments sold? It is simply to line the advisor and their firm's pocket versus your pocket. Remember, your investments should be liquid, low cost, and really designed to profit your portfolio and not that so-called advisor. So number 1 on my list are annuities. Annuities are blatant garbage, but they're sold a lot. And why is that? Because of the hefty commissions they generate for the advisor. Again, your advisor's acting in a sales capacity. Your advisor's probably not managing any money at all and probably doesn't even understand how the markets work. But he sure or she sure knows how to sell you that annuity that's going to ultimately rob your retirement security, and you'll realize 3 to 4 years down the road after you were sold the annuity that you made a big mistake, but you still can't get out because of the horrendous back-end surrender penalties. The other investment that is often sold by these fee-based and commission-based advisors, especially through Wall Street-style firms, non-traded real estate investments. These are horrific. They often come with about a 20% haircut off the top of your investment, and the key is non-traded, meaning they are not liquid. You could be stuck in these things for 20 or 30 years, and when you realize 2, 3, 4 years down the road that investment, that non-traded REIT, is not working out for your portfolio, you can't get out because, again, it's not liquid. And why would you ever buy an investment that takes 20% off the top haircut of your original investment? Imagine taking $100,000 of your hard-earned money and they take $20,000 off the top for underwriting fees and commissions when you buy that non-traded REIT. It's buried deep in the prospectus, but it's probably not going to be covered by that so-called advisor. Structured products are another one to avoid. These, again, are often sold by your Wall Street type firms. And why is that? Because they are big money makers for these firms. Structured products, again, typically are fairly illiquid. They have high internal cost structure and they limit your investment opportunity that you're going to ultimately make. The bottom line, structured products are manufactured because they constantly come due. Then that broker advisor gets to reload you in a new commission and a new commission and a new commission. Firms like these kind of products because, again, it lines the firm's money or pockets ultimately with extra fees, and it lines the advisor's pocket with additional commissions. Stay away from structured products, non-traded REITs, and annuities. And if you were sold one of these products or they're currently in your portfolio, that should be an instant red flag that your advisor is not a fee-only fiduciary money manager, and realistically, that advisor is probably not managing any money at all, talks a good game at the detriment of your retirement. Larry in Naples. My fee-based advisor is using what's called a third-party money manager for our investments. Does that mean he's not managing our money? What should I be concerned? Bottom line, Larry, is this. If you have a fee-based advisor, they typically don't manage any money. They're really selling other services. There may be a few fee-based firms that are doing some management, but I will tell you from our experience, the vast majority of fee-based advisors are not managing any money. They're selling things like you just discussed, a third-party money manager. What does that mean? Well, what that basically means is that big Wall Street firm contracts with these other various firms around the country, not the best ones, and basically, hey, we'll sell your services and you're going to pay us some extra fees to do it. And so those firms basically jump on board. So when you're talking with your advisor, he's not picking the best money manager. He's picking the ones that his firm has a special deal and a sales incentive to sell that is not going to go into your portfolio. So is your advisor managing any money when he's using a third-party money manager? No. He's selling you that, and he's acting more of a communication liaison and a salesperson, not really an advisor, not a money manager, but that fancy title might be foolish. What I would suggest you do, go to ReznyWealth.com, click on our special reports tab, download for free, Real Advisor, Fake Advisor. Learn the difference between a money manager and an advisor, a little bit more in depth, and you'll be glad you did. Dean in Fort Myers, Florida. What are your thoughts on oil investments now that Trump is in office? Great question. So, Dean, we have actually sold all of our oil investments a number of weeks or months ago. We started reducing our exposure probably over 3 months ago as we got closer to the election time. And the reason we did that, we felt fairly firm that President Trump was going to win again this time, just from what we could tell from internal polling. So we basically started positioning in our portfolio what we feel is going to be cheaper energy prices, oil and gas prices anyway. And what we want to do is we wanted to take profits. Now, we've owned oil and gas investments for a number of years. We bought them after Biden got in because he had a war on fossil fuels. So I felt that would be a great opportunity because oil is going to go up, more profits for the oil companies, good investment for our clients. That turned out to be correct. So we've now sold our oil positions, taken our profits, and we've moved that money to greener pastures. So I right now would not own oil investments. Now there may be a time down the road, 3 months, 3 years, somewhere in between, that oil gets so cheap that I may say it is an opportunity to add some of that back into the portfolio. But right now, President Trump is going to go and push oil prices down. We're seeing energy prices starting to move down already. And ultimately, that's not going to be great for profits for the big integrated oil companies. Bill in Cape Coral, Florida. Do you think UPS is a good stock? I think, Bill, I think UPS is a good company. I don't think it's a great investment. I think, generally speaking, if you own it, and again, I don't know how much of it you own or if you don't own it or thinking about it, what I would say is this. Anytime you buy an individual stock, never own more than 5%. If you own more than 5% of a stock, trim it back down to 5%. The reason you want to do that, you have to properly diversify your portfolio, and owning more than 5% of any one stock could create real havoc in the portfolio. But UPS stock overall is going to have very slow growth, earnings growth going forward. Remember, stocks go up if earnings go up. Ultimately, faster earnings growth drive stock prices higher. And on the flip side, if their ultimate earnings on these stocks are starting to go down, these stocks will ultimately often go down and crater quite a bit. If the earnings are somewhat flattish and not really growing at all, that stock may stay where it's at or continue on a downward trend. I think investors need to realize when you're buying individual stocks, don't buy them just because of the name. You have to really look under the hood, and buying individual stocks requires a lot of daily research. So make sure if you're buying a stock, you research it before you bought it, and you continue to research that stock after you buy it. Earnings drive price up, earnings drive price down, earnings decelerating goes down, earnings going up obviously will push that stock price up. I think ultimately investors need to understand buy and hold stocks is not a good strategy. Buy, research, and know when to sell is much better, and that's what our firm does every single day. I'm going to take a quick break. As always, go to ReznyWealth.com. We've got a whole bunch of different reports you can read. Educate yourself. Make sure the advice you're getting is truly advice and your money's actually being managed. We've got some great reports at ReznyWealth.com for free. Click on the Special Reports tab, go to ReznyWealth.com, learn, educate, and protect your money from bad advice. I've just released a groundbreaking report, the 3 biggest risks you must avoid now. If you're a retiree, pre-retiree, have at least $500,000, this is a must-read report. I've covered the risks to your financial security and the facts you need to know to protect your hard-earned retirement savings. If you're at all questioning the advice you're receiving or your portfolio is lacking returns, go to ReznyWealth.com and download your free copy. I hope you're enjoying today's program, and as always, make sure you send your questions to Brian Rezny at ReznyWealth.com. We love getting your questions. We like to make sure that your questions are answered so you can make informed decisions. You know, one of the toughest things for an investor like you, especially as you retire and you're a retiree, and you're really looking, hey, what are the next 10, 15, 20, 30 years maybe look? It's vitally important that your portfolio is properly managed, that you're making those important changes within that portfolio when necessary. That's why a firm that is truly a fiduciary money management firm like Rezny Wealth Management comes in handy, because we can do that heavy lifting for you. We can take that stress off your shoulders, allow you to be retired with your family, and do the things you'd rather do than worrying about your money. One of the things that I want to stress today is review your assets within your portfolio right now. It's time to upgrade. We're going into, obviously, a new cycle. We've got a new president. We ultimately believe within the U.S. we're going to have some of the best growth years that the U.S. has seen on GDP the next 3 to 5. What does that mean for the U.S. economy? And ultimately, what does that mean for your portfolio? As an investor, I urge you, look at what you have in your portfolio. What should not be there? What can you upgrade? What should be sold? And what can be improved? When you manage money professionally, like I have for over 30 years, every single day is a new day. We're looking at what we own. We may not be making changes every day or very often, but we're looking at what we own. We're looking at where that investment's headed on earnings, growth opportunities. Is there better places for some of that money? That's what money management is all about. And that's what you need to be doing with your money. Or if it's not happening, that's when you need a real money management firm. Also, focus on high-quality investments as we go into this new cycle with strong fundamental growth. What does that mean, high quality? Again, I'm urging you, the investors, stay out of international, stay out of the emerging market economies. Focus high-quality companies, growth companies within the U.S. One of the main growth sectors that we're invested in heavily is the technology sector. And why is that? We are going to see major growth that's going to occur in the U.S., and most of that's going to be driven by what? Technology, whether it's AI, whether it's semiconductors. These areas are going to push the U.S. economy higher and ultimately drive the world economies in a better place. But we're going to be the recipients of greater profits, in our opinion, in the U.S., hence U.S.-centric. Consider selectively adding to positions at discount prices. So what if you buy an investment and it temporarily comes down a little bit? What do? You basically, as long as that investment is still sound and it makes sense, you add to those positions selectively. Remember, just because you buy an investment today doesn't mean it's just going to keep going up. It may go down 10% right after you buy before it starts moving up. So remember, add selectively to quality positions that have growth characteristics on earnings. That is one of your best opportunities to upgrade your portfolio and hopefully garner additional return. Herman in Cape Coral, Florida. I'm using a guy on the radio who also has a program. He sold me 2 equity index annuities and uses third-party money managers. From your information, he is really selling and not managing our money. I am not happy, to say the least. Are you taking new clients? Herman, yes, we are taking new clients, and I probably know who you're talking about. Unfortunately, the vast majority of these advisors are not managing any money at all. They might talk a good game, but at the end of the day, you're either a fiduciary, fee-only fiduciary money manager, and I would get that in writing, by the way, or you're selling other people's products and you're really an advisor acting in a sales and kind of a communication liaison role. What I think you, the investor, are starting to realize, and probably a lot of the people that listen to my show, they really need to open the hood of that car or the advisor. Look at what they really do. Are they managing your money, or are they really selling somebody else's services? And are your needs being met? And is it your advisor's fault for your poor investment returns and poor client communication? Sue in Naples, Florida. What are your thoughts about technology investments going forward? Well, Sue, I made a comment earlier. We like technology. In fact, technology is one of our highest ratings across the board in all of our client accounts. Remember, we manage money. We're looking at daily research. We want to own areas of the U.S. economy and sectors that have the best growth opportunity going forward the next 3 to 5 years. I'm not looking at the next 3 months. I'm concerned about the next 3 to 5 years. We like technology. As I made a comment earlier, semiconductors pretty much drive everything, and they're inside of every pretty much device you can have today. If you look at AI, artificial intelligence. It's going to be another huge driver. But what's going to power AI? Semiconductors. There's areas of technology that are going to be vitally important. Another area we like in the technology side is really on protection of data. So these would be obviously companies or sectors that really get involved in protecting your data on your computer so you can't get cyber attacks, things of that nature. These are things that are obviously on the rise, and these are things that need to be protected. I think investors, one of the interesting things for you, the investor, is that you realize that look at where things are headed when you drive your car. And again, when you're managing your own money or somebody's managing for you, we look ahead what's happening, where are the opportunities, where are the obstacles, where do we need to move our clients' money in order to best position them for profit and growth. Ray in Naples, I'm a conservative investor, almost 74. Many of my municipal bonds are being called and the bonds available are at high premiums, low yield. What does an investor do? That's a great question. So bottom line is this, interest rates clearly are coming down, bond yields are going to be low. So what I would say to you is this, bonds are not conservative investments, by the way. They can be very volatile and aggressive depending on the interest rate cycle. Did you ever think about maybe hiring yourself a money manager who can actually manage your money effectively given your risk profile instead of just buying low yielding bonds that maybe are not the most appropriate investment for your portfolio? That might be a better option. The other thing I would suggest you do is go to ReznyWealth.com, click on our special reports tab and download for free the 3 biggest risks you must avoid for 2025. Tom in Cape Coral, Florida. What are your thoughts about investing in banks and financials for dividends? We actually like the financials right now, especially the big money center banks within the U.S. So we do own some of these now, fair disclosure. But I would say I like the big banks within the U.S. I think there's going to be great growth potential going forward. Let's just put it that way. The dividends on a lot of these banks are of quality, so that's a positive. But think about what's going to grow. If the U.S. economy is growing, the U.S. bank sector is often a big recipient of that. Interest rates, as I made a comment earlier, are starting to come down. That is a net positive, and that's positive for financials. Folks, I want to thank you for all of your questions. It's time you lift the weight of financial stress from your shoulders. It's time for you to look out for your financial security. Smart investors, just like you, are ditching that so-called advisor, and they're calling Rezny Wealth Management for real money management. We can help you too. Honesty, integrity, compassion, and competence is the difference we provide. Rezny Wealth Management. Give us a call today. Schedule a consultation. You will be glad you did. Have a safe and profitable day. I've just released a groundbreaking report, the 3 biggest risks you must avoid now. If you're a retiree, pre-retiree, have at least $500,000, this is a must-read report. I've covered the risks to your financial security and the facts you need to know to protect your hard-earned retirement savings. If you're at all questioning the advice you're receiving or your portfolio is lacking returns, go to ReznyWealth.com and download your free copy.